Coming up today, stocks bounce back. Is the White House trying to engineer a recession? The likely winners and losers from tariffs? The US takes back the Panama Canal? Big changes coming from Europe? And why there's reason to be optimistic. You came to the right place, folks. Let's go. And here's something we haven't seen for a little while, a sea of green across the board as markets found their feet today on a bit of a bounce back in key stocks out there. Welcome back to Click Capital, everybody. I'm your host, Jared, and I'm going to get you all up to scratch on everything happening across financial markets today. And we're continuing to get buy signals on my indicators across the board on key indices and stocks. S&P 500 was actually the Magnificent 7 leading the indices higher here today. More bullish signals on the Qs and the Russell 2000 as well. Still deeply oversold down here. And just looking at my S&P 500 oscillator, it too is still oversold, climbing back, but my market risk on risk off indicator went back to shaded green on the chart, along with getting some reversal signals on the VIX index. But we are still quite elevated here, just underneath 22, and still officially on what I'm calling the dicey zone. The spread of the VIX front month contract versus the second month futures contract still above 1. Option dealers still pricing in a lot of volatility for the here and now, still giving us a little backwardation in the volatility term structure. So it looks like we're in the process of making a low. However, we can't really confirm that we've seen it until this spread goes back below 1. Still got 2 trading sessions left in this week. Market may well indeed be still on edge a little bit going into the jobs report on Friday morning. That comes in weaker than expected. It could fuel further economic slowdown fears. However, just looking at price action, like I said, we're getting a bunch of reversal signals out there on key stocks. Tesla here again today, also trying to find support around this 280 level. And my institutional buying indicator going pretty high there to 63%. Has to go above 55 to go green. And the last time we saw this higher level reading was on the 22nd of October, which was down here before their second last earnings. That was the second last time I added to my position. And something to note with this indicator, just because it's gone red doesn't necessarily mean it thinks institutional money is dumping hard. In fact, it more likely means they're not just buying as much as what they did back here. But again, here we are getting pretty good readings on this indicator as well. Same deal on NVDA, getting some reversal signals. Institutional buying indicator going green. And we do have some pretty good bullish seasonality coming in over the next couple of weeks and month into NVIDIA stock. And just a quick reminder, anybody out there who wants to get my seasonality forecast indicator for free, just click the link below this video or head straight on over to my website, clickcapital.io/free. Just enter your email, TradingView username, and give us a few hours and you'll have this indicator inside your TradingView account later today as well. And this is something I and many other traders use to help add edge to our trades, as it works on every asset around the world, no matter where you are. And just looking at Bitcoin, we did trade up there today, but this is really jamming around. Mixed seasonality over the coming days and weeks, but we are getting pretty sizable bullish divergence on the DSI here. And this is my enhanced version of the RSI. The reason why it's called Dynamic Swing Index is because the oversold and overbought levels are dynamic. They adjust to each asset. Taking a look at other key stocks out there, Alibaba having a strong rip here today, along with all Chinese securities actually. There's FXI up about 5% and strong move there on Chinese internet shares. KWeb up over 7% on a momentum thrust. Still plenty of activity in Chinese shares and a bit of a bounce back in the growth trade. That spread we've been watching the last couple of days, high beta versus low volatility. Looking like a potential bottom here. But what's really moving out there today, international shares, especially European stocks, pushing up to yearly highs here, with Germany one of the leaders. Brand new all-time highs for the DAX. Up over 4% today on the American listed ETF, EWG. Also got strong moves coming out of Italy, France, Poland, and quite a few others, in tandem with a continued sharp pullback in the dollar and what looks like a bit of a rotation out of US assets into some European ones, especially on the back of some big announced deals. As it just so happens now, they are ready to step up. Just heard from the European Commission president coming out with a bold initiative to mobilize up to 800 billion euros for their own security. Defense stocks over there loving it. Spearheaded by Germany as we witness big tectonic shifts in global affairs and politics and how the world is run. No surprise to see the Euro 10-year yield spike up on that as well, 2.8%. So this is long overdue and well and truly needed for European markets. Some stimulus, some spending, some idea of becoming somewhat independent again. And it seems financial markets are liking that. But we've actually got US government bond yields going the other way of the dollar today. 2-year stabilizing here at 4%. Telling me this is more of a rotation over the last couple of weeks anyway. How long it goes on for is another thing. Out of US assets and the dollar into European assets, rather than so much growth scares for the US economy alone. Otherwise, we would have seen yields continue to crater. Instead, we've got strength in the euro coming off a months-long base here. And on the back of OPEC Plus announcing they're not going to cut production, this big support zone on crude oil could very well get tested over the coming days. days. Prior low around $65 a barrel, and just going out to a weekly chart here, this could very well give way, if not over the coming days, potentially the weeks and months ahead, thanks to a huge oversupply in global crude. And this to me is a good tailwind for economic growth, along with inflation coming down and rates as well. However, here in the short term, it could be setting up for a buy the dip swing trade. We are really oversold here, just looking at the oil and gas ETF, XOP, multiple indicators suggesting we're close to a reversal point. Although if crude oil does lose that support zone, that's more a negative for the medium term. But in addition to oversupply, I think crude selling off hard is also due quite a lot of geopolitical risk premium coming out of the markets. Chances of war spilling over are continually getting dialed down. But stick with me today because we'll come back to the charts later on. I'll show you a few other stocks I'm looking at that I think could be a buy the dip opportunity. But first, just looking at some interesting stats. This pattern we've been seeing all year continuing to play out. Hump day, middle day of the week, continuing to be the best performance. Wednesday's tracking an annualized return of 101%. Seen a few shocking Mondays and weak Fridays as well as the market's taken off risk. Going into the weekend, last Friday proved to be a bit of a reversal. Did come into it very weak. Was the last day of the month. And since we've had bonds and stocks moving opposite directions of late, a lot of big funds out there have to rebalance their portfolios by buying stocks and selling bonds, as the yield differential has moved in favor of equities. But not many people are buying into this dip. In fact, just yesterday, we've been seeing peak put volume on S&P 500. People buying insurance, in addition to us just coming off peaks in extreme pessimism. But have we already seen the worst of this correction? S&P 500 pulled back about 7% from highs. The Russell 2000, a much more broad and representative index of the US market, pulled back 17%, which looking back in history, we generally only get every 2 years or so. Like I said, if the Russell goes down another 3-4%, we're going to get the bear market headlines. But keep in mind, most years we do get that 10% correction, so it shouldn't be all that surprising to see the S&P go down another 3-4%. Whether we get that in the next 2 trading sessions or next week is still yet to be seen. Like I said, volatility term structure still in backwardation. This is where lows are made, and looking back in history, it can definitely get worse from here before it gets better. But technical signals across the board suggest markets are trying to find their feet here. But believe it or not, the fear and greed index still in the extreme fear zone at 22. Same level we've been in for over a week now, and a bit different from this time last year. But it's really not surprising at all. Investors are just being hit with headline after headline. Beware a recession that could be triggered by a chain reaction of tariff risk. The American exceptionalism trade died awfully fast. I'm going to remember these headlines and we'll come back to them in a year or two, see how they turned out. Stocks have been sinking. This time Trump's team doesn't care, as he no longer appears to be tracking his presidency success through the lens of the stock market. Something I've touched on, and to which I do think there is a valid point here. He was a lot more observant of the stock market in his first term, whereas this time I think it's more the 10-year yield, and he does have more of a tolerance for volatility. He's trying to do what he thinks is right for his country, and like the old saying goes, can't make an omelette without smashing an egg. But some are taking it a step further. Is the White House trying to engineer a recession? That would certainly bring rates down. However, I'd have to disagree. I don't think his team are actively trying to plunge the states into an economic recession. But all of these tariffs give plenty of fodder for financial and mainstream media outlets to play with. However, I don't think it's the strategy that's the problem. It's just the man enacting them. Because no one has a problem when others like Warren Buffett push for the exact same thing. Like he did a few years back by writing an entire article for Fortune magazine. Over 20 years ago, he pointed out the huge problem with America's growing trade deficit. Selling the nation out from underneath us. Here's a way to fix the problem, and we need to do it now. So Buffett, a wise businessman, investor, understands finance probably better than 99% of people out there, knows through studying and reading books like The Wealth of Nations. You can't keep going on with these huge trade deficits, sending trillions of dollars overseas, not only in trade but in war and corrupt aid, and expect the country to end up rich. Fact is, it's unsustainable. America has a higher debt to GDP than pretty much all of their trading partners, but are still expected to foot the bill like we're back in the 1980s when things were totally different. So Buffett did come up with his own unique system to achieve balance in trade by issuing what he calls import certificates to all US exporters in an amount equal to the dollar value of their exports, and he even admits himself, while it might sound gimmicky, the truth is it's a tariff called by another name. And so like I said, nobody's got any problem with the strategy. It's just who's doing it, right? Just like nobody has a problem with Buffett and his often quoted solution for getting the US deficit under control. And so that's the difference between what the US government spends and what they take in with tax. His idea, you just pass a law that says anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. He said politicians don't fix the deficit because there's no real incentive for them to do so. It's so true, right? in the commercial sector, leaders are held accountable if they blow out their budgets. They get fired, they don't hit their performance compensation incentive. But where's that for politicians? And I'm not just talking about the states. In all of our country, governments should be run like businesses. Give them a list of KPIs and make 90% of their compensation based on their KPIs. Benchmarks, along with relative performance, comparing states or regions to one another. Incentivize governments to actually look after their people instead of it just being a revolving door from the private sector to the public sector, and politicians like Nancy Pelosi and her husband accumulating over $300 million of personal wealth by trading the same companies they regulate. It's kind of like football umpires. Betting on teams and games that they're umpiring might create a little bit of a conflict of interest, right? Truth is, the US has been on an unsustainable path. Buffett's seen this coming for years. Now that a team's in there finally trying to fix it, most people trying to tear them down. Maybe if it was Buffett doing it, it'd be a little different. And there's a look at the US budget deficit as a percent of the GDP. So in 2016, it was 3.1, 2017, 3.4, 2018, 3.8, 2019, 4.6. Obviously blew out with COVID, but the government still kept spending throughout those years afterwards. In fact, spending like we're in wartime, like we saw previously back in World War II. Again, simply unsustainable levels and why big changes need to be made. But anyway, for those who think a recession could be coming this year, well, if you're in the States, you can go to a site like Kelshi. You can buy $1 for 42 cents. Market currently pricing around a 42% chance. We will get a recession this year, definitely higher than when we started this year, but still lower than before the election. For those of you outside the States, you can go to Polymarket, get an even better deal. Buy $1 for 35 cents, almost a 3-to-1 return whether the US goes into recession this year. So investors are getting bombarded with these headlines and rhetoric and being convinced to play defense. Seek safe havens, go into staples, buy some bonds, maybe some healthcare companies, even just cash out of the market altogether. But like I always say, you're better off riding the inevitable storms, volatility, and even bear markets through staying invested in the market with diversification. Trying to time entire markets with all of your wealth is a recipe for disaster, whipsaw, and missing out on some of the best markets. But nonetheless, if tariffs do accelerate on the upside, no doubt there will be some sectors and companies, at least in the short term, more exposed to their knock-on effects. Some of the winners will be service companies, software, healthcare, consulting. Don't rely on imported goods and don't face direct tariff repercussions. And the losers, well, that's the opposite. Sectors and companies that do rely on imported goods, IT hardware, equipment, autos, and other consumer goods, along with potentially price of your avocados, most of them coming from Mexico at the moment. But fear not, there are plenty of other fruits out there to choose from for those that can't afford a potential 20-30% increase in the price of their avocados. And here's a look at a chart of some of the most affected categories from tariffs on China, Mexico, and Canada. Welcome to pause your video player to take a look. What you'll find, most of it discretionary stuff, with computer and electronics being the leading categories. Like I said last year, it was a good time to buy the dip on a new TV during the Cyber Week specials. And here's another interesting chart going back to 1890. Average US tariff rates. A lot of people don't realize back then tariffs were how governments funded themselves. There wasn't even an income tax back then. And the circular trend is for them to be coming down, but here in the red, things have changed a little bit. But it's such a fluid situation, back and forth. Like I said, it can be dialed back with a stroke of a pen. Trump delays Canada, Mexico tariffs on autos. Got a nice pop there in the automakers today. Also mentioning he's going to further incentivize automakers making their cars in the state. So GM and Ford are much more exposed to this than Tesla. A lot of people don't realize Tesla is the most American-made car out there. About 90% of all parts in a Tesla coming domestically, much higher than the other major automakers. Fact is, the US economy is still growing. We heard that from the ISM today. We've just got a lot of uncertainty at the moment and fears. It's kind of like anxiety. Thoughts of impending doom that have yet to materialize. But you can theorize and worry about anything. What happens if you get hit by a bus? Should that mean you should never cross the street again? Of course not, right? Life's all about accepting risk. And in my opinion, manufacturing's still on the rebound in the States. Just like the new Secretary of Treasury, Scott Bessent, said, Trump has already secured over $1.7 trillion in new investments just 6 weeks into his administration. American manufacturing is surging amid Trump's strategic tariffs, almost getting big deals by the day, with America's largest asset manager, BlackRock, acquiring the Panama Canal ports on both sides. Key asset and infrastructure in the world to control. A lot of the world's trade goes through there. Americans first built it. The Chinese were on their way to taking control. But now BlackRock has bought it off the Hong Kong company that previously held it, along with dozens of other ports around the world as well. We also just heard Tesla officially sign a 5-year lease for the first showroom in India on the back of Modi's visit a few weeks back. He met with Elon. It's been indication they want to dial it up over there, potentially a gigafactory. And this is on back of the new admin negotiating with Indian officials to remove tariffs for US auto imports. Once again, I believe all this is going to result in the end for better deals for American companies. Plus, it was also good to see from the man who hardly misses, Jim Cramer, a never Trumper, come out and say, "I do not see a deal on the horizon." Looking back in history, it's actually inverse Cramer who has the better track record. That gives me reason to be optimistic that some deals are likely to get done. And looks like the problem with the record illegal crossings at the southern border didn't have to do with some technical legislation being held up in Congress. It was indeed, in fact, just a new president. That's all that was needed to fix that within weeks. But it's not just many Americans doubting whether this is all going to work. Obviously, global investors as well, while we've seen a bit of a departure of the US dollar into European assets, as we're getting big stimulus measures coming from them, in addition to the Chinese, still think they can grow GDP 5% this year, and still saying they're going to do whatever it takes to prop their property and stock markets up and ensure they get their 5% GDP goal. Just moving on, good to see a stock I'm a long-term investor in and have been buying the dip of late. Moderna put in some really good price action there today, as we just got news CEO bought 5 million in shares. That's a pretty decent amount, and obviously implies he thinks the stock is good value. He likes what he sees ahead. Sometimes you'll see CEOs just buy a smaller amount, like 25,000, 50,000, 100,000, to try and signal confidence to the market. But when they spend decent amounts in the millions, it's a bit of a tell, and that's why the market reacts. We can see in the price action here today, nice good move up off the lows on volume, up over 15%. And this has been trying to form a base for a few months actually. But to my eye, looks like some big accumulation going on at these levels. And just looking at some other stocks I alluded to earlier that could be ready for a potential turn here. Looking good on the indicators, PayPal over 14% below the 50-day VWAP. Still a strong, dominant, growing business. And another fintech, Coinbase, may be looking to make a bit of a turn here. And some other key stocks, Robinhood, DraftKings, and other growth leaders also trying to potentially put in a bit of a swing low here, as we can see in the spread of high beta versus low volatility. But some of these defensive sectors have already started pulling back the last couple of days. Utilities was actually down today. Staples jamming up, and healthcare somewhat as well, but looking a bit better than the other defensive sectors. Another potential sector that could come back to highs quickly, agricultural fund, DBA. Food is definitely coming in to play with tariffs, likely to place upside pressure on agricultural prices. And even though we got yields pulling back along with that TLT, good signs in high yield bonds holding ground there. But like I said, notable today was the move in European markets. The 10-year popping up, really big move there, 280. Along with the move in European stocks, which actually, kind of like China, been performing a lot different than American shares so far this year, as the world is nervous about everything Trump is doing. But if they're wrong and his strategy actually work, we could see a very big reversal by the dip on American shares, along with a recovery in the dollar and growth stocks as well. But for the here and now, we still have volatility. Like I said, still got some backwardation in the term structure. Fixed one day still at 22. We're likely to see some further whipsaw in the remaining two sessions of this trading week. However, to my eye, looking likely we could be in the process of making a bit of a low here. And that's a wrap for the daily market review today. Thanks very much for tuning in. I appreciate you supporting this channel. And as always, you're welcome to leave your thoughts in the comments below. That's all for today, and I'll see you guys again this time tomorrow. Cheers.